there. If you can hear me, Seshadri, am I audible to you?
Yes, I can hear you clearly.
Perfect. So if you can answer on the metals pack as a whole, and what are your top recommendations there? What's the thesis?
We initiated on non-ferrous metals. I'm not the analyst for that sector, and our thesis is that we believe that aluminium prices especially are looking set for a very strong upturn, and we are picking some stocks in that sector which have the maximum exposure to rising aluminium prices.
Okay, so that's the thesis behind that. But overall, for the markets, what's the sense? Because we are in a bit of a sideways zone at the moment. Do you think that's the nature of the market for the next few, months at least? And what's the sense? Is large caps a better place to hide versus broader markets?
Uh, yes, to the first part that we are in a period of extended consolidation for the markets. While the upside is capped by the valuation, the downside is protected by the fact that earnings seem to be resilient through this period. So India will continue to trade at a premium to other markets and to its history because of the overall stability and growth that the market is delivering. As far as hiding in large caps, I don't think that is by definition something that would play out. There are some portions of large caps that may be vulnerable. We would go more by sectors than by cap universe. We continue to see plenty of opportunities in the mid and small cap space. While the headline indices there are expensive, that's a large space and there's plenty of reasonably priced opportunities there. So our view is that it would be more sectors than market cap categories that would define our performance.
The recent correction that we had seen, which are those sectors that are looking attractive to you, both in large cap and the mid and small cap space?
So the three sectors we like, consumer discretionary, because that includes autos, and that's one sector where we think going into the festive season there will be some momentum on the retail side, and there are still stocks there with reasonable valuations. More in the CVs and two-wheeler space, but we like the entire auto space. The second is energy. While we think we are in a long-term trend of oil prices remaining within a band. At this moment, that may look a little alarming, but we think that this is a temporary phase. Energy companies, as years go by without oil prices not significantly appreciating, the profitability and the core fundamental strength improves. They're available at reasonable valuation. So these are two sectors that we like. Healthcare is the other sector that we continue to be positive on.
It seems a bit counterintuitive when you talk about autos and energy, in the sense that autos right now going through a bit of a rough patch. It seems, at least the latest data coming in from SIAM, or the inventory, or the fact that the discounts have increased in the festive season. What within autos is your preference? And with the Hyundai IPO coming in, how do you expect the landscape to change?
We like the two-wheeler space, and there's plenty of value there. There is, the problems of inventories and demand seem to be the least. So that is where within the auto space is our preference ordering. Passenger vehicles, we're relatively a little more cautious, and the IPO will probably add to that headwind for the time being.
Also, given the fact that the Q2 earnings are expected to be weak, in fact, the EPS growth expected is expected to be the lowest in the last 17 odd quarters. Do you see a risk to the FY25 EPS estimates, and that could also lead to further downside when it comes to the benchmark?
No, not at the moment. We'll see how the result season goes. But if the market delivers as per expectations, I don't think that there is significant risk to the Nifty EPS estimates. The headline numbers for 2Q do look a little soft, but that's primarily down to two sectors, energy and cement. And that is, one is an unseasonal, exceptionally pronounced seasonality in cement, which will unwind itself as we go into the second half of the year. The other is a high base for energy, which again unwinds itself as we go into the second half of the year. Both these are fairly well known. I don't think that they will affect the overall earnings forecast for the Nifty at this point in time. The surprise, if any, will come from elsewhere. But at the moment, we don't see any source of major negative surprise.
Looking at any negative surprise as such, we talked about the sectors that you're positive on, but which are the spaces that you would recommend to stay away from, either book the profits or at least stay away?
Um, we are neutral on most sectors, but one sector where we are underweight for the longer term is financials. We have been for a while. Having said that, this quarter may be a sweet spot for financials because we've seen the RBI ease liquidity, and if they don't cut rates in this quarter, which is a possibility, then that's a sweet spot because you're going to get benefit from higher deposit growth, but not have to pass that on. When repo rates get cut, you take an immediate hit on margins. If that doesn't manifest itself, especially because financials are underperformed, there's a bit of TINA factor, you may see a short-term rally in financials. But longer term, we remain underweight. We think that financials still not have adjusted valuations of private sector financials to the fact that their growth rates are much lower than they used to be. And that is a long-term overhang on that sector, which we think will continue.
Thank you, sir, for joining us and for giving us all those details. With that, let's slip into a